Good afternoon. There's still a few copies for those of you who haven't got a copy of last year's inaugural lecture. I still found a couple of these leaflets. The format today will be different. I will essentially read existing notes, and the reason why is because I'd like to make comments on some excerpts from different writings from Lord Adair Turner. And last year I was very lucky that through the industry of Christina, who found a way to interview Lord Adair Turner for her dissertation, that she could add a few questions that I would ask him in order to write a column for the newspaper Le Monde, where I write a monthly column. There's one out today, by the way. And Lord Adair Turner was between 2008 and March of this year, 2013, he was chairman of the Financial Services Authority, which at the time was the only British regulator. Now it's been broken down under a number of different bodies, and his name was mentioned as a possible successor to Mervyn King at the Bank of England, which would be renewed at about, the position would be renewed about the time when Lord Turner would leave his position at the FSA in any case. But in the same way as another contender lost his chances for being appointed as a successor to Mervyn King because of the LIBOR scandal, and the suggestion that was made by some people when they were interviewed or interrogated, that, what was his name? His name escapes me, unfortunately. But there was suggestion that he had given instructions to bankers to manipulate the LIBOR numbers in order to suggest that the British financial industry was in a better shape than it was in the very early year 2008. Which most people agree was the thing to do in order to salvage the system overall, but it shouldn't be in the, how would I say, in the defined function of a regulator to ask people, even for the best of intentions, to manipulate prices. The reason why Turner was not appointed at the Bank of England are probably related to the things I'm going to say today about his work. He introduced, in 2009, he introduced that notion that we should possibly discourage financial activities which are not, he used the phrase socially useful initially. Later on, because of the stir that had produced the way that he said it, he suggested he should have said economically useful. But the fact is that in an interview which was published by Prospect magazine on the 27th of August 2009, he did actually use the phrase socially useless and socially useful to distinguish financial activities. The interview, it was part of actually a kind of panel discussion. It was called "How to Tame Global Finance" by How to Tame Global Finance. Why did he get into trouble for introducing that word socially useful, using the word social? Essentially because that word has been banned from the from being used within the financial community. This is part of what I mentioned about the debate about a possible extraterritoriality of finance as far as ethics is concerned, which is very much an issue we are dealing with here. And in a later interview, he says in particular, one city practitioner declared himself appalled, disgusted, ashamed, and usually embarrassed that I should have lived to see someone who commands a senior and crucial important position as head of a UK regulatory regime making such damaging and damning remarks. I think we should, I mean, we here, and me in particular, I guess should be in reverse, appalled, disgusted, and ashamed, and usually embarrassed that using the word socially, the phrase socially useful would be regarded as such a scandal in the city, because he was essentially addressing himself to people in the city being the part of the London town, which is devoted to financial activity. Turner got in trouble, I'm writing here from my own notes, with the financial community when making this distinction. Why? Because of a view that had been dominant within that community since the 1970s, that such a distinction is not only irrelevant but dangerous. Friedrich von Hayek, Nobel Prize of Economics in 1974, claimed that the notion of social justice is meaningless, that doesn't have any meaning at all, which would make the whole issue of an ethical view being used to discuss financial matters as being meaningless, also imagine. Milton Friedman, Nobel Prize of Economics in 1976, 2 years later, claimed that any concern about social responsibility would necessarily lead to totalitarianism, by which he meant communism, which was still existing in those days. Because, as you may know, neither Hayek or Friedman had such qualms about other types of authoritarian regimes, because they both volunteered to be advisors of General Pinochet in Chile, which you may know was at the head of a counter-revolution, if you wish, although Allende had been elected according to democratic principles by being, voted in the election. So when these two people talk about totalitarianism, they didn't mean at all authoritarian regimes of any type, but only of the communist type. In his response to the uproar which had been produced by his August interview, Turner made some remarks 1 month later in September, and I've already quoted that his first comment there about one city practitioner who was so appalled that that word social had been even pronounced to when speaking to a community of people, financial people. He went on, Turner. Some commentators, responding to my interview, and indeed to Stephen Green's speech, that's, as I mentioned, I mean, it was part of a panel discussion, his comments about socially useful, have challenged whether we can ever make such judgments about the social usefulness of economic activity. After all, they say, in a rich society, there are many products and services which people buy but do not need. What of the fashion industry? What of much of media and entertainment? What of the arts? But there's a big difference. The products of the fashion industry are consumer products, consumed directly by individuals. And in a free and rich society, we should accept and indeed relish the fact that consumer choice is in part driven by fancy and caprice, but desire for luxury and style and indulgence, not by need. Products and services chosen directly by customers don't need to prove that they are useful. The fact that consumers choose them is enough. And then he adds, but nobody maliciously, but nobody gets up on a Saturday morning and says, oh, I know it's indulgence, but I think I'll go and buy one of those lovely new CDO squared, collateralized debt obligations squared. Why does he mention CDO squared? Because this is very much the product for which it is regarded as totally, how would I say? I try to find the right word. Unjustifiable, that the rating agencies have assigned ratings to the fact that, to a product like a CDO squared. Why is CDO squared? Collateralized debt obligation was typically made out of about 150 certificates, which had been cherry-picked individually from within other existing collateralized products. Collateralized meaning asset-backed to some kind of product. Typically a mortgage, a prime mortgage, some amount of money that's been lent to somebody in order to buy a house, or subprime, a subprime mortgage assigned to somebody whose financial situation is not that convincing in terms of being able to refund the money that's been advanced. But other things like airplane leases, money that's been lent for making a film, a number of possible debt where advances are being made for one or other project. A CDO is made out of typically about 150 slices that have been taken from individual asset-backed securities, collateralized, and that's another way of saying so. When I say slices or certificates, the word used in English is actually the French word, a tranche, a slice, the French word for slice. How were these slices produced? Well, typically, when you're making a security, which is a debt instrument, you're going to aggregate a large collection of individual loans. And I've already mentioned that in particular in the first lecture, but I haven't explained what a tranche is. People will be paying different types of cash into that big box, that big chest that will be made out of all the payments. For instance, there will be a difference between making interest payments and making amortizing payments. Amortizing meaning that you are repaying already in advance part of the loan amount of the money that's been borrowed. And as you know, typically on a mortgage, when you're making monthly payment, there will be some element of interest in that payment, but there will be also some element of repayment, early repayment of the money that's been advanced. You can also make a big payment by refinancing with another financing company. And then you will prematurely, let's say you have your mortgage for 30 years, but then somebody approaches you saying, I can give you a better deal. And usually there's a penalty attached to that, but I mean, usually the banker that approaches you for offering you a new mortgage was going to pay that penalty. And so there might be also a large payment, which is a premature a premature payment of the amount that was borrowed. So in that chest that will be making payments, there will be interest being paid, there will be early prepayments, there would also be scheduled prepayments, which are part of your monthly payment. So you could possibly make tranches in your product by selling to people, meaning people will give money to, that's the money being used for lending it to other people. They may take a tranche which is actually made out only of interest payment or only of principal, the principal being the loan amount payments. That's one way of doing it. Another way of doing it, making slices within that particular big debt instrument, a security, as which is the word used in English, is to slice them in terms of rating, of a credit assignment. You're going to put your different categories of loans let's take a very simple case. A very simple case would be that you, the very simple case that I'm talking about did not exist. Does not exist. It's just for the sake of making up an example. But let's say you're going to take 6,000 individual loans, but you're going to take 3,000 that are prime and 3,000 which are subprime. Now, I just said that was not done. Subprimes were not mixed with prime. But let's just imagine you would do that, and that you would assign to people who want to buy tranches. Let's say you would have two tranches. One would be corresponding to people who pay subprime, and another one will be people who pay prime. Now, the people who pay prime, they're not paying as high interest. If you were a prime borrower, you will be assigned, for instance, I don't know, 5%. 5%, no, I'm taking too high figure, let's say 3.5% on your monthly payment interest. But if you are a subprime, you will pay 7. Why? Because there's a risk premium that is higher if you're a subprime. Now let's say that, out of that imaginary security made out of payments made by subprime borrowers and prime borrowers, let's say that I make two tranches, one for the payments would correspond to the payments made by subprime borrowers and the other one to subprime. Now, the one with the higher interest payment would be also the one that would have a lower rating. Let's say typically for subprime it will be at most a C. We usually discuss AAA, AA, B, triple B, etc., etc. If it were made out just of subprime in the way I'm just describing, it would not be higher than C. So you would have high interest payments on your charge. Let's say not the 7% because there needs to be some profit for the banker, but let's say 6%. And but the rating would be low. You would have your assigned by the rating agency, you would have a C grade or C notation associated to that. And if you were receiving the payments made by prime borrowers, the rate would be lower. As I said, 3.5. Well, maybe you would get a 275, but you could have a AAA assigned in terms of a rating. And what does that rating measure, of course? Well, the likelihood that the money will be paid at the end. So you get a higher interest, but you got a higher risk of not being repaid the full amount of the money. As I said, that's an imaginary example. But it was just to explain to you what are these tranches which are made within security. Now, in a CDO, you're taking 150. You may take a few from the same, possibly the same security, but you may want to diversify, for instance. You may want to take 150 mortgages from different places in the United States. Why would you do that? Well, to diversify, to reduce one particular risk, which would be economic risk. It used to be that when there were economic crises in a country like the United States, it would not happen in the same way everywhere in the country. Because typically, as you know, for instance, the car industry used to be concentrated in Michigan, and in particular around Detroit City. And there might be a crisis in the car industry, which would not correspond to, let's say, making aircrafts, like in some part of California. And for that reason, you may diversify, reduce your overall risk by lending money to people in different parts of the country. Now, we know that for recent crises, well, they touch about the same way the whole country. But for minor crisis, it was a good idea to indeed diversify in that particular way. Now, let's imagine I have a CDO, which is made out of 150 of these products. As you imagine, it's already a quite difficult task. It's a difficult task to assign a rating, a particular rating, to one security, out of which these tranches will be cut out and put in different CDOs. If you put 150 together, well, you have to do the same exercise 150 times. That's quite obvious. Usually the rating would not be done by looking individual in 150 tranches. It would be done just on that view that I just mentioned of diversification. You would just look in terms of diversification. And that's what one of the reasons why the rating of the CDOs broke down totally when the crisis started in 2007, is because at that time we had a crisis that started, which was one of these crises, which I just mentioned, where the aircraft industry went down in synchrony with the car industry going down in Michigan, and because it was a major crisis for the whole of, not only of the, as you know, from the United States, but it spread into the rest of the world. So assigning a rating to a particular CDO is already a difficult exercise. Now, what is a CDO squared? It's like when you say 5 to the square is 25. You're making a CDO out of slices of tranches of different CDOs. So I don't know the figure. If somebody has got a calculator there, 150 to the square, it's a large number. It's a quite large number. So in order to assign a rating scientifically to a CDO squared, which were products that did exist, you would have to make, what is it, 1 million calculation on individual tranches, which nobody bothered to do. And that's why the CDO squared became the symbol when everything broke down of typically the kind of thing we should never have done if we wanted to manage risk altogether. Why did the rating agencies accept to do that? For the reason I mentioned in an earlier lecture, because in order to maintain market share, because if you went to Moody's and say, can you do that? They would say, sure, of course not, just in fearing that if they say no, people would go to Standard & Poor's, and these people say, of course we can do that. The fact is that nobody knew how to do it, and a product like that should never have been developed. The fact is, unfortunately, that these are private businesses. They do what they want. If they say they can sell something, well, that's it. There's no overall body that could have said a CDO squared should never be sold because it's impossible to manage risk altogether. That's why when I'm asked about a rating agency, I say it should be a public service that should be delivered. At the same time, and that's something I add immediately too, we should make sure that such a body would then be properly independent from the industry, which would be a challenge in itself, because none of this supposedly independent body in finance are protected against lobbying from the industry, making that they end up doing what the industry suggests they should be doing. And a good example of that is the International Accounting Standards Board, which produces the accounting standards, the norms about how to do your accounting properly, which is supposedly an independent body, but is not, because it's only financed by the industry itself and by the big audit firms. And as I mentioned in an earlier lecture, is located into a tax haven as a supplement to the lack of independence. So when Turner mentions the CDO squared, he's making a joke of that time. I read that sentence again, but nobody gets up on a Saturday morning and says, I know it's indulgent, but I think I'll go out and buy one of those lovely new CDO squareds. And the fashion, media, or arts industries cannot create financial instability and cause economic recessions. Financial services are different from those industries because they are intermediate services. They are the plumbing of the economy, but a very complex plumbing, and if we get it wrong, potentially explosive. He's writing in 2009. So we must ask searching questions about whether society is getting these crucial plumbing services as efficiently, at as low a cost, and with as little risk as possible. Some comments on my Prospect magazine interview have suggested that any regulator ought to wish their industry to be as successful as possible and therefore as large as possible. So sorry, I read it was a wrong stress on the sentence. Some comments on my Prospect magazine interview have suggested that any regulator ought to wish their industry to be as successful as possible and therefore as large as possible. So one of the people who replied to him made a comment, say, well, if you say it should be socially useful, you're putting a limit to the size of what it is. And you shouldn't, because in business you should try to make your business as big as possible. And Turner is answering this, is responding to that. That is frankly a bizarre idea. Nobody suggests that it is the role of Ofgem to make the electricity industry as large as possible. He mentions the name of a British energy supplier. To make the electricity industry as large as possible. Obviously, if there are sustainable, valuable financial services which the world needs, we should be pleased that Britain is good at delivering them. But any idea that that means that size is an objective, even if the activities are likely to harm global and economic stability, is absurd. And we see here, because, I mean, I think we already kind of guess why he wouldn't be appointed at the Bank of England. He's suggesting that finance is a stewardship that should be there in order to help the community and shouldn't be regarded as a business like any other business. And he doesn't even say it like any other business. He said energy suppliers are not trying to become as big as possible. They're not trying to force, let's say, down the throat people buying oil or electricity or gas, although they may try. And I think I think the merchandization of the world has been very much in that direction, that independently what product you are selling, well, you're trying to sell as much as possible. And apparently, somebody made that, what Turner regards as an absurd remark, that the financial industry should be as big as possible. But as I said, the mainstream view, which is still the one developed by people like Hayek and Friedman in the 1970s, and of Gary Beckman, no, what's his name? Nobel Prize 1986, Gary Becker. Gary Becker. Gary Becker is precisely the person who says that everything should be very much in that view of merchandization of the world, that everything has a price, that you should marry the wife that will, or the husband that will maximize your economic wealth, that you should that you should choose the amount of children that will maximize the economic wealth of your family, and that you should advise your children to go into the professions that will make them to possibly maximize their economic wealth also, leading to some interesting, I would say, theoretical debates of where should we put money in the working of a society. Instead of using properly ethical principles, because as you aware of now, ethical principles are not very much in high regard in that community, that you should determine, for instance, your penal system and your judicial system in terms of the cost effectiveness of it. That, for instance, maybe, let's say, the optimal number of, that you should define your rules, for instance, or the size of your police force by the optimal number of culprits that are being captured in order to maximize, for instance, the management of jails and things of that type. This is not the view, I would say, which was common in the legal profession, although it may become so too, you never know, that you should look at, that you should replace ethical principles by principles of maximizing the best possible use of your resources. That would, maybe the calculation would lead to the fact that it's not very important to capture more than 10% of the people who commit some particular crime, because that would be the way to maximize the use of the money would be assigned to the judicial system. This is not the way we're doing currently, but it may, if we're not prudent, if we don't pay attention, that view may very well develop. In the rest of the lecture, I'm going to use a quote from two other texts. So far, I've mentioned that initial article interview where Turner used that phrase, socially useful, and then in the response he made to the outrage from some people to that. What I'm going to do now, I'm going to use some other two texts he's proposed, both, by the way, in 2010. One is called "What Do Banks Do? What Should They Do? And What Public Policies Are Needed to Ensure Best Results for the Real Economy?" And that was given at the Cass Business School on the 17th of March of 2010. And the other one is called "Economics, Conventional Wisdom and Public Policy," which he gave at the Institute for New Economic Thinking. It's been funded by George Soros, a well-known international speculator, at Cambridge in April 2010. So they were given in quick succession in March and April 2010. It's not accidental that you will notice a number of resemblances between the views I develop in these lectures and those of Turner, because we hold very similar views on many subjects. There is something which is quite remarkable, and I will mention it ahead of speaking about it specifically, is that, and that's also some point of convergence, I would say, is that nearly everything that he regards as being negative in the current functioning of finance is linked to speculation. There are very few things which are not part of speculation that he reproaches to the industry. But he doesn't use the category as such. He refers to it using, sometimes, very occasionally, use the word speculation, but most of the time he characterizes in a different way. And when I will mention it, I will draw your attention to the fact that he's talking about speculation there, although he calls it differently in that particular part. This, the fact that he supports actually eliminating speculation from finance to make that transition from finance as it is now, which I could characterize as some of his opponents there, as being something that you need to make as big as possible in order to make as much money as possible, or something that should be the steward of the society, and in particular in its role, which is its main role of being the steward of the economy. And a view is often mentioned, and I'll go into his own arguments about that speculation is necessary for the working of our economy. But as you may know, speculation has not been around all the time. It was banned in Belgium until 1867, in France until 1885. In different countries, it was authorized at different times in that, let's say, second half of the 19th century. There's only one country which never had, in the Western world, which never had any specific laws about speculation, which is the Netherlands, Holland. But as you know, they had some very early accidents also related to speculation, like the famous tulip mania. I don't know if you heard of that, but in the 17th century, speculation started on a very grand scale in Holland about tulip bulbs. It was the time when tulips were coming from the East. It was part of the work of the East India Company that was bringing back spices, but brought also decoration items like flowers, and in particular bulbs of tulips. And then to hybridization by local Dutch people, they managed to make tulips of very, very different colors of petals. And a speculation developed in the country where you would pay what would be a couple of thousand euros for some bulbs of some specific tulips. And it was not a Ponzi scheme, because I mean there was a product, a particular good, a particular commodity was sold, but they developed a kind of a mania, a craziness that led to people to sell and buy these bulbs before they would flower. I mean, before they would flower, and the price would go up, the price would go down, a bit like in currently about the Bitcoin, that parallel money system. So the case of Holland doesn't show that it was a great idea to authorize speculation, because they were involved in one of the first bubble that developed around a product, and that led, of course, to crashes at some point. The whole thing collapsed. Another point which I have with Lord Turner is the fact that he regards that one of the main culprits of the crisis and the difficulties we have now are the shortcomings of economic theory. It's not only the practice of financiers which is responsible for the trouble we are, it's the fact that there's a combination between practices and the faulty explanatory framework we have for how things do work. Rather than fraud, Turner regards as the main culprit of the recent crisis our poor understanding of economic matters. Fraud does exist, of course, but our lack of correct understanding acts as aggravating circumstances. Turner doesn't state that economic theory is erroneous. He is not as, how would I say, he's not as open as I am. He says that our errors derive from oversimplified interpretations of or he uses also the word overconfident interpretations of economic theory. The fact is that in practice, I mean, if you're looking at particular statements within economic theory, it's very difficult on practical terms to distinguish an erroneous theory from a theory whereof the most common interpretation happened to be incorrect. He says the following: there's also a strong belief, which I share, that bad economics, or rather, he's using here what I'm just announcing, or rather oversimplistic and overconfident economics helped to create the crisis. There was the dominant conventional wisdom that markets were always rational and self-equilibrating, that market completion by itself could ensure economic efficiency and stability, and that financial innovation and increased trading activity were therefore axiomatically beneficial. He's using there the phrase market completion. Market completion is a basic, how would I say, theoretical issue within economic science. It is derived from a theory developed in the 1950s by Kenneth Arrow and Gérard Debreu. It says the following. I'm quoting from one of these articles by Turner. He says here, in one of these two papers from 2010, the first fundamental theorem of welfare economics, demonstrated mathematically by Kenneth Arrow and Gérard Debreu, illustrates that the competitive equilibrium is efficient, but only if markets are complete, i.e., if there are markets in which to strike all possible desired contracts, including insurance contracts and investment contracts linking the present and the future, as well as markets for current goods, services, and labor. That notion of of complete markets, meaning that you can get an economy in a real equilibrium where things could actually be, how would I say, you could put things in automatic pilot, and I'll be quoting from Alan Greenspan later on about that. That can be achieved if a market is complete. If all possible operations, transactions that you can think of are allowed. For instance, I mean, that would allow, for instance, what we call naked positions, positions which are properly speculative. What is a naked position? It's a position where you insure yourself, well, in one type of instruments, but in one type of instruments, a naked position where you insure yourself against a risk you're not exposed to, meaning that you're taking a position where you will benefit as if you were the victim of a loss, but that you are not. Like, and I gave an example, another example of that in a different case, is where companies taken a life insurance against for some of their employees, the task of which is not fundamental at all to the operation of the company, like somebody who's cleaning the floors in the corridor and who could be replaced very easily on the job market by somebody else doing that. That market completion theory has been fundamental in justifying all possible financial innovations in terms of new products, independently of what is the risk associated to them. So for instance, you would say, well, the CDO squared, that's a possible product, and there might be somebody that for a good reason or even for a bad reason, because it's irrelevant, wants a product like that, and therefore it helps the market as a whole to go closer to equilibrium. Since 2008, since the breakdown of the financial system, the notion of systemic risk, of the risk that can possibly destroy the whole system, has become more relevant, and we don't regard anymore that any product should be developed independently of what risk it produces, except that economic theory is still what it was, and therefore is still ignoring that particular aspect of things. And there's still, you will see in the literature, the stress is still put on the fact that an innovative product, a new financial product, is by necessity good because it contributes to that completion of markets. What Turner underlines also, he says, well, when you come up with an oversimplified view of economics, it can very well stiffen into an ideology, which is then implemented into policies and business practices. And to a large extent, that's the view that some people have, including me, that what is called the Chicago School in economics is very much that. It starts from an oversimplified view of economics, which stopped at some point being tested to the experimental facts, because that's also a major defect of current economics. It has that the stress has been removed on testing the views with actual examples, things in the world. I received a couple of days ago an article showing that that's the same what's happening currently in physics, that the emphasis on testing the theories has been is moving away little by little, which is, I mean, to me, that's the degeneration of a scientific approach, supposedly because it's too difficult to test the theories. As a consequence of the oversimplified views and their stiffening into an ideology, Turner says the following: as a result, a set of policy prescriptions appear to follow. Macroeconomic policy, meaning global policy, fiscal and monetary, was best left to simple, constant, and clearly communicated rules with no role for discretionary stabilization. Deregulation was in general beneficial because it completed more markets and created better incentives. A justification, a theoretical justification in that line for removing any rules that would try to, how would I say, safeguard and put limits to what you could do or not. Or if there had been a rule preventing you from building a CEO squared by saying that the risk cannot be measured around that, well, deregulation, removing these safeguards, makes it possible to complete markets because it allows you to develop whatever product you wish. And he says that explicitly here. Financial innovation was beneficial because it completed more markets. And speculative trading, here he's using specifically the words speculation or speculative. And speculative trading was beneficial because it ensured efficient price discovery, offsetting any temporary divergences from rational equilibrium values. This is something I'll come back to because that's also one of the tenets, one of the central dogmas, that prices are established out of a, that if markets are symmetrical, meaning that the information is well shared between the buyer and the seller, then the price will set itself necessarily at an objective, its true possible price. And that is discarding the fact that people may speculate and actually push the price in one direction or other just in order to make money. This is not, that does not exist within economic theory. Speculators have no room. They are not there as a specific category. The notion of a speculative price, I already mentioned that, does not exist in economic theory. All prices are objective if symmetry between buyer and seller is ensured. He goes on, and complex and active financial markets and increased financial intensity not only improved efficiency, but also system stability, since rationally self-interested agents would disperse risk into the hands of those best placed to absorb and manage it. There was that view when securitization started on mortgages, that it would disperse risk and that therefore risk would be diluted within the community and not concentrated, and therefore that the process of securitization as such was something helpful for the economy. I don't know if I mentioned it, but briefly I will say what happened instead. What happened instead is just the reverse. An asset-backed security collateralized, backed by subprime loans, was supposed to be relatively safe because of internal mechanism within that security in terms of provisions of reserve that would be made. Typically in a prime security, the principle was the following, which was we had what was called senior and junior tranches within these securities. What did that mean is that if you assigned a very high rating, like AAA, meaning that the risk of non-payment is nil to a particular tranche, you would ensure that that would happen really in the following way. You would create junior tranches, also called subordinated, where you would actually draw the money if needed in order to make sure that there wouldn't be any risk at the top. You would actually introduce within your security like pipes. The pipes going to a reserve, which would be the subordinated classes. And the fact is that that worked on prime loans. It did on prime securities, on the so-called mortgage-backed securities. It did work pretty well because people had been chosen in such a way that the likelihood they would repay on their, they would make the monthly payments on their loan would work. In asset-backed securities backed by subprime, there was what's called a sinking fund. which was just a big reserve within which you would make sure that the whole, you would, how would I say, put some amount in brackets as being money that would be drawn just in case of an accident. The fact is that that big reserve in the very beginning of these existing of these securities would not be used at all, and that the companies would even sell in advance to potential customers these reserves because they wouldn't have been tapped at all in the process. The fact that when you made a security which was made out of subprimes only, it happened that the reserve, however it had been calculated, was not enough, and it didn't work at all, as you know. As you know, as I said before, new financial products were introduced, although there was no way the risk involved could be assessed. I gave the example under CDO squared. The rating agencies, however, claimed that they knew how to assess that risk, a claim justified only by their fear of losing market share to their competitors had they admitted they didn't know. About that view that I just quoted, speculative trading was beneficial because it ensured efficient price discovery, Turner dismisses it through the example of credit default swaps. Credit default swaps, I think I've already told you, it's a derivative financial instrument. A CDS acts as an insurance instrument on a potential loss associated to a debt instrument, i.e. when one has lent money. It is possible, however, to contract a CDS despite not being exposed to any actual loss. I just mentioned that before. This is called taking a naked position on CDS. And Turner shows that the market-defined value of CDS premium, essentially determined in most markets by the speculators holding naked positions, was at its lowest just before the crisis started in 2007. That prices represent objective value, including speculative ones, is, however, a linchpin of economics. He looks at an article in particular that has been made. If you just mention what the CDS is, credit default swap, you have bought an obligation, a bond, a note, a bill, meaning that you have lent money to somebody, and you may, let's say that you bought one which has, let's say, triple B as a rating. Well, you know that the rating agencies is not assuring you entirely, therefore, that the money will be paid, either the interest payments, periodic interest rate payments, or even the refunding of the amount as a whole. But for some reason, you were interested in the high yield, the high interest rate associated to a triple B, but you want to cover yourself for the potential risk of no payment. You go to somebody who's prepared to deliver you a CDS, a credit default swap. And that means that if that money, interest payments or principal repayment do not happen, you will get from that insurer, you will get that money back. Now, what happened? But as I said, you don't have the person who will sell you that insurance, you don't have to show evidence that you're exposed to that risk. And therefore, you can take a naked position. You can say, well, I want to be insured against the fact that a Greek obligation may lose value, that the Greeks will not be able to pay fully the amount that was promised, the money that had been borrowed, which happened to be the case in 2011. And therefore, I want to insure myself. And if you're not exposed to risk, well, you just want to make a killing, you want to make some money if the Greek government gets in trouble. The premiums for that insurance, for that CDS, are determined by two mechanisms. One is the actual risk. You can calculate what is the risk that the Greek will not repay on their debt by looking into the figures of their economy, by how much income tax they've managed to gather last year, and so on, by the growth in the country or not. That's one way. But the premium, and that's the way normally an insurance premium is determined by the risk of the event of the loss occurring and by the average amount of the loss that will be incurred. That's the way you calculate how much would be the insurance on fire or flood or whatever. But on the CDS, because speculators may be there, speculators may actually push the price up and down just simply by supply and demand. Now the difficulty is if you regard that figure, the amount of the premium, which is actually defined by two factors, supply and demand for the insurance and actual risk, you will have a figure that you will not be able to disentangle. If the difficulty is that economic theory, by not accounting of the speculative element, tells you that you can always reverse engineer that figure of the premium, and that will determine the exact amount of risk that's there, because the amount of the premium you are asked to pay reflects objectively, because it's a price, what is the market, not in terms of supply and demand, but in terms of risk, because it is an evaluation of risk. And that explains what happened in the case of Greece in 2010. Some people would buy CDSs from the companies that were prepared to offer that as a product because they were exposed to a risk, because they were owners of Greek obligations. But some other would go there in order to push the premium up or down. They would sell and resell and buy their CDSs on the market, trying to make money, profit on reselling it for a higher price. Therefore, they would develop a trend on that market, a trend going up or down, and you would get into the position where you would have, I think at some point, I think it was on 3 months debt. No, it was on three-year debt, that the premium on Greek debt, when calculated in terms of risk, the risk was higher than 100%, as if you could possibly lose more than 100% of the amount that you had borrowed. But because the market had become speculative, that's what it was implying when you were reverse engineering the value of the premium as being reflecting actually risk. As I said, Turner uses as an argument to dismiss that, the fact that when you looked at what on CDSs, on losses on corporations in 2006 or 2007, that the implied risk within the CDSs was totally off the mark. I mean, it was not reflecting what we knew, what we know with hindsight later on, that was the actual risk. There is no correlation at all. So that analysis of the premium of CDS shows that view that price is objectively determined on the market is entirely false. And that underlines that, of course, these things have never been actually tested. In my own experience, when I found that the prices I was discovering I was analyzing in the fishing industry in France, that they were not confirming the law of supply and demand, I realized that although that law of supply and demand is regarded as a founding principle of economics, and that it was my case, you get stigmatized if you're as somebody who doesn't understand economics at all, if you question it. The fact that you can look for any article that has ever tried to confirm that theory, and it's impossible to find. It does not exist. A lot of these dogmas were never tested, and as I mentioned, there's unfortunately a trend that should become even more the case. On the issue of dispersion, of risk with securities backed by mortgages, home loans, there was in truth no dispersion at all. As I mentioned, banks kept those for themselves as the returns, high interest rate promised were high. This being the case because of the poor quality of the borrower, requesting a high risk premium, and rating agencies guaranteed that risk on the securities was low. The view was that risk would be dispersed because a large number of people would buy these securities. But what happened is that the banks realized quite easily in the case of the subprime loans that you could have AAA tranches within these securities that they would have high yield. They would pay a lot of money. Why? Because the borrowers were people who were paying a high amount of interest rate, and that therefore you could at the same time have the assurance of very low risk and have a high yield. So these banks didn't make any effort at all to try to sell that to a client. They put that in their own portfolio. What happened then in August 2007, when the people who had subprime loans started making default on them, not repaying the interest and not making the principal payments, is that the financial industry knew that these prices were not as imagined initially. They're somewhere dispersed, between families all over the globe, but they would actually be essentially in the vaults of the different banks. And because there was no official figures about where these would be that you could turn to, distrust appeared between all the banks, and they stopped lending money to each other, although that commerce of borrowing and lending between financial establishments is very much part of the working of the system. How did we know that it was not happening? Because the interest rate that they charged to each other started having an incredible values. It was rising, expressing essentially that these loans between banks were not taking place at all. And it is at that time that Mr. Paul Turner, that I didn't remember the name initially, lost his chance of becoming head of the Bank of England, because he called people in different banks saying, please lower that figure, because that figure of the interest rate charge between banks is suggesting that the industry is actually at a standstill, that it stopped operating altogether. So the dispersion that was supposed to take place did not take place at all. There was apparently little risk and high yield, and banks did not disperse it in the community. They didn't sell it. They kept it for themselves. This was not understood at all, and Turner is quoting an IMF, International Monetary Fund, report dated February 2007. There's an irony in the date, February 2007, because that's very much the month when the whole subprime industry collapsed. That's when the BBB subprime securities lost about half of their value within a period of 2 weeks, over a fortnight. But on that very month, the IMF was claiming the following. I quote it from Turner quoting it. There is a growing recognition that this dispersion of credit risks to a broader and more diverse group of investors has helped make the banking and wider financial system more resilient. Their improved reliance may be seen in fewer bank failures and more consistent credit provision. And that would collapse, at the very time when the report was released. Alan Greenspan, Turner underlines also, made statements at the same time in the same way. I'm quoting again from Turner. Numerous speeches by Alan Greenspan, who was, I remind you, was at the head of the Federal Reserve, the American Central Bank, for 19 years, from 1987 to 2006. Numerous speeches by Alan Greenspan enunciated the theory, a doctrine indeed, that market completion was via financial innovation was delivering both economic efficiency and stability. Risk managers in banks applied the techniques of probability analysis to value at risk calculations without asking whether samples of recent past events truly do carry strong inferences for the probability distribution of future events. I read it again because I put a stress in the wrong place. Risk managers in banks applied the techniques of probability analysis to value at risk calculations without asking whether samples of recent past events truly do carry strong inferences for the probability distribution of future events. Value at risk is a analysis of past potential loss made by a company based on a totally flawed representation of the world in terms of processes being of a very tamed, financial processes being of a very tamed nature, called a normal distribution or Gaussian distribution, which makes it possible to make predictions within, a certain range of certainty. The fact is that it has been shown for at least 50 years that financial prices do not work in that particular way. And despite that, underlying Basel regulation for Basel III for banks, Solvency II for insurance companies, still use these totally flawed, inaccurate assumption as part of the calculation of the reserve that should be made, reserves in capital and equity that banks should be made. There's I mentioned that before, there's a total insulation of economic theory from physics. The underlying physical world of economic theory does not look at all of what physicists think it is. It has some resemblance to the representation physicists had when economic theory started in the 1870s, but not anymore at all in nowadays. But the fact is that even when we try to make provisions for possible losses, these flawed, old-fashioned, disconfirmed theories are used for making our predictions. It's particularly ironical now that when there was a refusal from the industry to dismantle the establishments, which are the businesses which are too big to fail, because their failure would be systemic, would introduce would destroy the system in their wake. That the industry pushed that it would be replaced by additional reserves, although now the industry, when the calculation has been made, decided that it's too expensive to pay that. But anyway, that the systemic risk has been assessed as being equivalent to 1.5 to 2.5 more reserves, but that calculation has been made on that assumption that financial phenomena are reproduce, have a normal distribution, which has been disconfirmed for, as I said, at least 50 years. I go on with a quotation from Turner. And then regulators such as the FSA, which is at the time when he wrote it, he was still the head of, the assumption that financial innovation and increased market liquidity were valuable because they complete markets and improve price discovery were not just accepted, they were part of the institutional DNA, part of the belief system. So it was not, as he says, it was not some view that could be discussed at meetings. This was the way that it was regarded as being the case. Turner then, in that same article, alludes to Goldman Sachs betting in 2008 on the downfall of mortgage-backed securities, while the CEO of the company, Lord Blankfein, claimed about this that he was doing God's work when Goldman Sachs was caught encouraging some of its clients to bet on a product that had been designed to be as bad as possible, there was a senatorial committee called, I think it was in last year, 2012, and Lord Blankfen being interviewed in the process says that bankers like him were doing God's work. And Turner comments on this by saying, market efficiency and market completion theories can help reassure the top executives of major financial institutions that they must in some subtle way be doing God's work, even when it looks at first sight as if some of their trading is simply speculation. Here he uses the word speculation. Although they had the intuitive feeling that what they were doing was pure speculation and was detrimental to the operation of the financial system, economic theory may have convinced some of these bankers through its deluded representation that what they were doing was, however, beneficial. This is in case Mr. Blankfen was somewhat in good faith when he said that he was doing God's work, meaning that that he's doing his business, and when he was asked to describe it more precisely, he described it as being a market maker. When it was known that that meeting, that senatorial hearing would take place, and that I read in the literature, in the financial literature, that Mr. Blankfen would be in trouble. In a column on my blog ahead of that time, I said no. He won't be in trouble because he will say he's a market maker. And that's what he did indeed. What did that mean, being a market maker? He meant that he was simply an intermediary between two types of clients. Clients who want to sell something through his business, and people who want to buy something, and that he simply put him then in touch with each other, which is the position that he developed. And because he could do that very skillfully, because the notion of speculation not being inexistent within economic theory, he could actually hold a speech, I would say, in the exact terms, vocabulary of Milton Friedman, Friedrich Hayek, Gary Becker, and so on, where the category would be inapparent because it does not exist. He would say, I'm not making any bets on the evolution of a price. I'm just putting in touch people all together. You may know that in recent times, Morgan Stanley and Goldman Sachs have been in trouble to some extent, because now they're trading on commodities, and they're doing what is called cornering. They accumulate quantities of some products, and they're delivering them at a very slow pace, producing a dearth of that product, making it difficult for people to acquire it, simply because there are long lines in front of the hangars due to the bureaucratic process of delivering the goods. And this is, of course, deliberate. It's called cornering, and the word in French is accaparement. It is trying to, concentrate a large quantity of a particular product that's needed by some people, like grain. Typically in the French Revolution, I mean, people would try to accumulate grain, and so the production of bread was difficult. And in the Constitution of 1793 in France, it was actually never implemented. Cornering, accaparement, was regarded as a crime that would be punished by the death penalty, because it is very possible actually to paralyze indeed the economy by a true cornering. There are some famous cases. There are two brothers, and their name escapes me, who in the 1980s, as far as I remember, tried to corner the silver market. And at some point they really managed to, I think, to accumulate something like a third of the total quantity of available silver. More recently, there was a famous trader in cocoa who also managed to buy a quite sizable part of the production of cocoa over the world. He miscalculated about the weather developing in one particular country, and he crashed on that. I have a lot of material from Turner, and I won't be able to use it at all. But I think it's interesting because we can cover in this way a number of aspects, as well the aspect of fraud, as the aspect of structures, and also the that combination that I've tried to stress, to emphasize in previous lectures, a combination of deliberate criminal or delictual behavior, some structures which have been developed in one particular way and that we fail to understand exactly how they work, and then, unfortunately, tools which have been designed in order for us to understand these things and which have not done their business, explaining to some extent that vacuum that was the one in 2008, when not only had the economic profession not been able to predict that crisis coming, but then remained totally mute in terms of what needed to be done then. It was part of my experience. I have no training in economics, but I was regarded as having been one of the persons to explain why the crisis would come and how it would then develop. I was part of discussions in groups of economists, and these meetings were organized in order to come up with views about what to do next. And nothing was actually happening there. People were essentially scolding each other, or, calling each other names, saying, well, it's because you're a dogmatic Keynesian that you don't understand that. The other one, you say you're an idiot from the Chicago school and so on. But there was no possible progress. There was no possibility for people saying, well, okay, let's start from here and see what we can do next. Because there was no theory of what had happened and no theory of what should be done from there. As I mentioned about speculation, the words that would have needed to be used were not existing. It was not part of the vocabulary. The theoretical framework was inexistent. It had been produced elsewhere to some extent by physicists who were working on economy, and which was my own training to some extent from economic anthropology. You had a toolbox that was of some use, but which, I mean, there was no overlap between that toolbox and that used by the economists. I'd like to, because there's a few minutes left, I'd like to read some explanation from the theory about why liquidity should be something really positive. I would be quoting again from Turner. If I can find it. I made the error to not to put any numbers on my pages. I think I will not manage, and as there are only 5 minutes left, I'd rather turn to you and see if you have any questions about what I've been saying here. You have a question? Yeah.
Just a side note first. You talked about the cornering of the cocoa market.
About the
cornering of the cocoa market.
Yes.
That was Anthony word. And then you were mentioning also the cornering of the silver market. That was
Yes.
Brothers Hunt. Brothers Hunt.
Hunt. Yes, indeed. Yes. Yeah.
In the 80s.
Yes.
And just for the information, like on the cocoa market, Anthony Ward tried to corner the market by actually leveraging position on, I think, something like 250,000 tons, metric tons of cocoa, all by himself.
Right. Yes.
That's quite funny. I have a question.
Yes.
What you said about the discussion that other journalists had with an opponent about the size of businesses. And other journalist was wondering why should businesses grow as much as they can to make as much money.
Right. Yeah.
Socially useful that can be. And the first thought would be that the opponent seemed to imply that it was something that was
Yes.
natural things.
Yeah.
Well, even trees don't grow forever. There are antitrust laws pretty
Yeah.
much everywhere in the world. In the US, you have the Germans and I don't know which one,
Yeah.
antitrust laws that were used in the past.
Yes.
For Standard Oil, for example, with the oil.
Yes.
There is also legislation in Europe, but lately
Yes.
most prosecutions, they end up with just financial settlements
Yes.
or payment of fines, which can be quite important.
Mm-hmm. Mm-hmm.
It's just about that, but they're not dismantling anymore companies like they did with the Standard Oil, which
Mm-hmm.
divided into 34 companies.
Yes.
Recently, there was an article in the Financial Times about Google, which is now using his search engine to actually promote products,
Yes.
which seem to have a premium of an average 34% compared to the very same products that are actually deeper in the index when you're
Yes.
using a search.
Yeah.
So there is an obvious monopoly
Yes.
of their position to actually sell things for much more than what they're actually
Yes.
worth, so to say.
Yeah.
So along the reflection of Turner, would it be socially, would you say that it would be socially useful to actually limit the size of companies, and when some of them are already either too big to fail,
Mm-hmm.
too big to jail, or now even too big to be honest? And if so, how do we define when a company has become too big? We already know how to do that for the financial institutions. It's when
Mm-hmm.
they present a systemic risk.
Yes.
That's why I said. But for the other companies, how do we do it?
Yes. Well, he makes a number of remarks about the what he calls the diminishing returns, and he says, for instance, about liquidity. He says we can imagine that it's important to have more liquidity on a market. What is liquidity? The liquidity is a possibility for somebody who wants to sell or buy at a particular price to have improve the probability that that will be possible. Let's say that there are very few people on a particular market. There might be what we call a wide spread between bid and ask. And what does that mean? That some people would like to sell something, let's say, at 50 euros, and some other people are prepared to buy at 20. And people may be entrenched on their particular position. People will say, well, there's no way I can sell it for less than 50 euros. And they would say, well, there's no way I will buy it for more than 20 euros. Now, if there are a large number of people on these markets, well, the likelihood will be improved that there will be people somewhere in that spread, and it will make it easier for the operation to take place. So it may be interesting, and that's one of the arguments for getting speculators in markets, that you will improve the likelihood that a buyer or seller will find a counterparty at that particular level. But Turner says there must be some limits, some limits to that. There might be a time when the marginal benefit of adding more people may not be worth the trouble. And that may be the case, indeed, if things become too big, and answering your question, too big compared to what they're supposed to be. And he gives some figures of, he says this, the value of foreign exchange trading has exploded relative to the value of global GDP, of global trade, from 11 times global trade value in 1980 to 73 times today. A figure that's often mentioned about gold futures is that every day is exchanged on these markets 7 times the total available quantity of gold on the surface of the earth. The other figures he gives, the value of oil futures traded has increased from 20% of global physical production and consumption in 1980 to 10 times today. That means that in 1890, on the futures markets, was exchanged every day 20% of the available quantity of oil. But now it's 10 times of what is available that's being traded. Now, what he suggests is that when you reach to that particular size, it's very unlikely that the presence of all these speculators would be of any use to anybody. There are too many in any case. We don't need all that additional presence of potential buyers and sellers. And then he goes to a further argument, which is that, and there he refers to it like Keynes does as a psychological process, to the fact that trends develop of people who are trying to push the price down or the prices up. And I think that the error there, and which is, in my view, an error which you find in many, many places in Keynes, is the fact that when he had no real understanding of what was going on in a particular place, when he had no proper theory, his tendency will say, well, there's some psychological process going on. And that's the difficulty I have with people who say that, who talk about herd instinct when there are trends developing on markets, saying that people mimic each other. That's an issue about a psychological disposition of people. You don't need at all that psychological explanation. People, and if you start from the principle that somebody who's trying to sell or buy is trying to make a profit, that's enough. If you see the price is going up, you're happy. If you're a seller, if you see the price coming down, you're happy as you being a buyer. And that doesn't require that you make any projection in the future or align your behavior to be like anybody else. The strategy of trying to make a profit is sufficient to explain what is going on. About the how to determine what is the systemic size is very difficult, because when you mention to these antitrust laws, as you know, they when they exist either within one particular country, like in the case of the United States and the antitrust laws that you're referring to, or let's say at the level of Europe, if you mention of laws that are passed within the European community. But the fact is that, and that's what's interesting in that article that made by Battiston and other people, is that an excessive size for a particular company may not appear when you look at things at national levels. That's only when you take the global view that you will see how much a transnational company is actually acting as a trust or not. And we see also that because of what is shown in that particular article, because of the mutual participations in companies, they may not appear as being, when you look at them individually, as being a trust, but because you would have to look at the underlying interest they have in each other, and that would appear then at the overall picture would appear only when you deal with the complexity of the situation as a whole. I'm thinking of another aspect, which is that some things are not necessarily easily captured by law. When we look now at the LIBOR scandal, where these banks were actually cheating on their figures, and as I said, a bank that was asked, what is the interest rate charged by other banks if you borrow from them? They have an individual interest of saying that a figure lower than the actual figure. Why? Because if they give a high figure, it may suggest that the other banks have no trust in them. So that's bad for the image of the company. So there would be a normal tendency to try to lower the figure, because that would reflect an improved picture of what the company is. What has not been taken into account when the investigation started is that there might be a collusion between all the banks to lower or to raise the price in a cartel by having agreed to do so. And there's a measure which was taken, I think it was it was sometime last week, that it's forbidden now for the traders in these different banks to go on chat rooms where they exchange information, and where apparently that's where the cartel was actually taking place. They were making the decisions all together there. And that may have escaped the regulator, indeed. I mean, because there is, through the development of the internet, an easy way for people to actually go to a place where they would agree to act in sync, to do things simultaneously. Now that's been, it's not even the law that has decided to change that. It's individual decision from the individual banks to prevent their traders to to go there. The fact is that at the national or even the multinational level, it's very difficult to get that global picture. And that's what Battiston and his collaborators say in the introduction of their paper, that they did something actually for the first time to look at an industry not according to the way that the statistics are collected, which would be typically at a national level, but to set up the problem to analyze, and to analyze it according to its very much features, rather than the classical way of looking at it. It's the same. I mean, that goes back also to what Turner says that about value at risk. There is a kind of tradition simply that you look at the historical figures for your industry, as if it was at any sense, let's say for a CDO. When the CDOs collapsed, they had existed possibly for about 20 years. Do these 20 years where everything was going fine, were there any evidence of what accident could actually happen? No, not necessarily. What did the rating agency typically do? They would look at the worst possible case in history and multiply the loss that was observed by 3. And that would be a rule of thumb. Why multiply by 3? I mean, there's no justification, just that, 3 times worse than what we've seen before looked like being a conservative approach. But in a crisis like in 2008, things will multiply by 20 and not by 3, and that was not taken into account at all. I guess it's part of our psychological makeup that we think that, when things go well, we say, well, that's because we've solved the issue for once and for all. And it turns out that's not the case. Okay, thank you. Thank you for being here today.